Good morning, everyone. I'd like to welcome everyone to our webinar, FX Market Volatility, Surviving and Thriving in the Midst of Currency Chaos, which is the first webinar in a three-part webinar series, FX Risk, Managing Volatility to Protect the Bottom Line. My name is Ernie Humphrey. I'm the Vice President of Educational Programs for Proformative, the online community for corporate finance, accounting, treasury, and related professionals. As a 15-plus year veteran of finance and treasury, I know, as you do, that assessing, monitoring, and measuring FX risk is confusing at best. This webinar series is about providing our audience insights regarding the current and emerging drivers of the ever-increasing volatility in currency markets, identifying key factors dictating the business case for a holistic approach to FX risk management, and sharing case studies from firms on the forefront of leveraging the latest technologies and techniques in managing currency risk. This particular webinar will focus on offering an assessment of the current and ever-increasing volatility in currency markets, practical advice in terms of identifying and monitoring the sources of FX risk that impact the bottom line at your company, and insights into the inherent and exogenous volatility in the currency markets which are most relevant to your firm. Before we get to these topics, I would like to thank our sponsors, Western Union Business Solutions and Fire Apps, whose commitments to supporting thought leadership in the arena of FX risk management have made it possible for Proformative to bring you this program for free. Today, we will hear a joint presentation from Wolfgang Koester and Karl Schmada, and then we will spend the remainder of our time in an open panel discussion. We would like this to be an interactive experience for you, so if you have any questions at any time, please go to the questions area in your GoToWebinar control panel and send us your question. We can't promise to get to all of them, but we will do our best, and we will follow up afterwards on any questions we did not get to here. Please note that we will send out soft copies of the presentation to all attendees later today. We are also offering CPE credits for the CPAs in the audience today, so please send an email to twalsh@proformative.com in order to receive your CPE certificate. Again, that's twalsh, T-W-A-L-S-H, at proformative.com. proformative.com. Don't worry if you didn't catch that email address. Tanya will be sending you the webinar survey and presentation slides later today. Okay, let's get started. I'd like to introduce our speakers, Karl Schmada and Wolfgang Koester. Karl Schmada currently serves in the role of Senior Market Strategist for Western Union Business Solutions. Karl has designed and implemented risk management and trading strategies for hundreds of companies ranging from small businesses to large corporations. As a member of the Business Solutions Analytical Team, Karl also provides market analysis and strategic guidance on a daily basis for thousands of international businesses. Karl is a regular contributor to a number of international treasury and finance magazines, and his market analysis and forecasts have been widely quoted on publications such as the Washington Times and the Wall Street Journal. Karl is a member of the Professional Risk Managers International Association and the Global Association for Risk Professionals, GARP, and is the president of the Association for Finance Professionals, Calgary. Now I'd like to introduce Wolfgang Koester. Wolfgang Koester currently serves as the CEO at Fire Apps. He has managed risk for Fortune 100 companies as well as governments, including G10s, since 1986. Prior to forming Rimtech, Koester served as president with GFTA, a quantitative currency manager. Koester also holds a Bachelor of Science from Arizona State University and a master's degree in international management from the Garvin School of International Management. Wolfgang was named one of the most 100 influential people in finance by Treasury and Risk in 2007 and 2009 and is a member of Global Exchange's 2007 Who's Who in Foreign Exchange.
Well, thank you for that introduction. I hope everybody can hear me okay. On today's agenda, we're looking forward to really looking at the trends that we're seeing with respect to increased globalization, really focused on what is going on from a corporate point of view, but also from a geopolitical point of view, sources of volatility, as well as how those volatility impacts are having to be looked at by corporations, and this is no longer only about dollar, euro, and dollar yen. And then we'll finish the conversation up by taking some questions and answers with respect to that, and more specifically as the first part of the three-part series. With that in mind, let's get started. every quarter we monitor at FireApps every earning call, and interesting in the last earnings call season versus beforehand was that top Fortune 100 companies looked at how many of them would actually look to grow internationally, and they mentioned as one of their top 3 subjects of growth that 62% wanted to and were going to look for increased international growth. That's a significant number. Some more details of that, for example, were that 71% of information technology sector companies, for example, no surprise here, were looking to significantly expand in China as well as other countries. With the growth in mind, historically what we've seen is that new markets were really defined into the G10 countries, and we're looking to grow in those countries. And as growth is softening there, really the new markets is now looking at all countries around the world, and that has its own impacts. Often those factors now are even referred to as the frontier markets, where we're really looking to expand globally. And this obviously creates some significant risks globally, as well as for corporations, of how to really look at these risks and move on with that. So Carl, I'll let you kind of refer a little bit more into the volatility of those before we then go into the details of how it impacts corporations.
Absolutely. Good morning, everyone. First thing that we want to look at here is the fact that volatility is not going away. We're actually seeing even the major currencies diverging further as time goes on. This chart shows the relative movement of exchange rates against the U.S. dollar since February 2008. Basically, we picked that point in time as the point at which the impact of the financial crisis turned from being an immediate crisis into an ongoing recovery. As you notice on the left-hand side of that slide, you see that a lot of currencies are moving in similar patterns with relatively high correlations. As time proceeds, we see most of the major currencies moving quite a lot more sporadically and erratically against each other. Ultimately, what this means is that the bottom line of companies that are exposed in these markets is actually diverging as well. We're seeing impact actually growing. If we look at what actually occurred during the financial crisis, what we're looking at here right now is actually historically typical balance sheet crisis recovery. What do I mean by that? Essentially, this crisis is much like the dozens of crises that have occurred since the emergence of the modern financial markets back in the 18th century. It's a broader, deeper crisis than most, but ultimately what occurred was asset prices were damaged, and that meant that businesses and individuals focused on minimizing debt instead of maximizing their profits. What this has meant since the financial crisis hit the world economy is that individuals and businesses have pursued ongoing deleveraging, paying off debt. They've kept consumption low. Loosening purse strings was very difficult in an environment where you had a lot of exposure to debt, and that's ultimately led to a situation where we have persistent unemployment really across the developed world and particularly in the United States. Now, what all this meant was that we had a political impact. We had countries and politicians concerned about their roles, and we saw massive, unprecedented levels of government intervention during the crisis. So debt mounted up to an absolutely spectacular level that we had not ever seen before in history, and we now have the developed world struggling under a large burden of sovereign debt. Ultimately, what does this mean? It means that these countries have, firstly, an ongoing carrying cost in the sense that they need to pay the interest costs on the debt. Right now, interest rates are relatively low, but this burden is growing. The other big implication is that historically, countries have not tended to default on their debt because they were unable financially to pay the debt. They have tended to default because they were unwilling politically to pay the debt. So what we're looking at is an environment in which we have escalating levels of political risk across the developed world. At the same time, we have extremely wide growth differentials among the major countries. So within Europe, we have essentially a two-speed economy led by Germany, lagged by the peripheral economies such as Greece, Spain, and Portugal. We have adjustment problems within the European Union, within the common currency zone, I should say, exacerbated by the rigidity of the single currency. So in other words, countries are not able to improve competitiveness by devaluing their currencies as happened historically. And therefore, we have countries yoked to the German economy and therefore underperforming. At the same time, debt burdens are rising. So we're looking at a situation where we have ongoing adjustment that needs to occur within the European Union. We have several meetings this month where Chancellors Merkel and President Sarkozy are due to meet in an effort to restructure the Eurozone to achieve greater economic integration, perhaps. But we also have the very strong possibility that we see one or more Euro members restructure their debt in the years ahead, which creates a lot of risk for corporates that are relying on inflows from Europe. At the same time, sorry, go ahead.
Go ahead, Carl.
No, go ahead.
I was just gonna say. I mean, to your point, I think that's very good. Is that Europe really, at some point after Greece, for example, was refinanced and people calming down about Spain, really thought, well, everything is going to be okay. And quite frankly, we're now going through this wave of refinancings again, where everybody has to look at, okay, now comes the second wave of financing, and with the downgrading of, for example, Greece by Moody's, this is starting to flare up again as an issue that everybody thought, okay, this was hopefully going to go away. And in this really volatile global financial economy, these sort of issues, as you mentioned already from a restructuring point, just don't go away. It's just a matter of can they calm it down a bit, but really Europe is still quite a bit in a hurt, and I think we'll talk a little bit more about how inter-round just Europe is.
Very much so, and you know, really the metaphor that we like to look at sometimes is just that the Euro situation is something of a pot sitting on a stove. Generally it's simmering, but occasionally it boils over. And you know, we're looking at a very unpredictable dynamic there, largely driven by politics within the European Union. And you know, this really adds a huge ingredient of risk into the equation. And you know, at the end of the day, the European Union is the world's second largest economy, if considered collectively. So we're looking at large impacts on the currency markets. Now, when we look at Japan, for example, we're looking at a more neutral situation. We're looking at a country that's essentially failing to adjust to new economic dynamics and really has failed to adjust since the 80s, mounting debt levels, but at the end of the day, a relatively safe and secure safe haven right now for currency traders. Somewhat of a factor on world currency markets, but not an enormous factor. At the same time, we have the UK actually growing more aggressively than many had expected. Austerity measures that were imposed just after the financial crisis by the incoming government have largely failed to dent economic growth, and we actually have inflation rising there. So rising inflation drives potentially rising interest rates, and we're seeing traders turn relatively bullish on the United Kingdom and on the sterling in specific, which is pulling some flow away from the euro itself. At the same time, we're seeing the United States actually accelerating. Growth in the United States is booming along here at a relatively aggressive pace. Stimulus is still pouring in. We have various stimulus spending bills that were announced during the financial crisis that are really only hitting the bottom line now. We have very loose monetary policy supporting the markets, and optimism is generally rising. We're seeing employment numbers actually rising on a relatively sustainable basis over the last 4 months. So what we're looking at here is that we have growth that's really likely to outpace Europe, the United Kingdom, and Japan, which is contributing to some of that divergence that we saw on that slide prior to this one, where we were seeing currencies actually move away from each other, and the U.S. actually outperformed surprisingly. At the same time, we have the commodity block actually outperforming many other currencies or many other areas of the world. So the Australian economy, the New Zealand economy, and the Canadian economy are actually growing extremely aggressively. Why? Because commodity prices impact their terms of trade, and commodity prices are rising. Why are commodity prices rising? Because of a lot of growth in the emerging world, a lot of demand there, and increased shift of the marginal supply balance to the emerging world. So, and actually I'll let Wolfgang talk about the growth there.
Yeah, thank you for that. I mean, overall, it's been really interesting over the last probably 10, 12 years. I've been reading every year their PricewaterhouseCoopers really take on how CEOs are looking at what's going on and what their top issues were. And, you know, over the last 4 or 5 years, currency has certainly risen to the top 3, maybe 4 topics. But what we've seen last year, really, the theme was all about survival. It was really looking at how we're going to survive through this financial crisis that certainly started at the end of 2008, or at least kind of rose to the top in 2008. But what we're really seeing in this annual report is that the CEOs are really looking to drive growth into the frontier markets, that they are really looking at other areas to look at, not just into the Euros and the UKs, et cetera, but really there's some significant changes. And even if you look at Switzerland, for example, you know, that's been just because also a flight of quality, but that's really impacting companies way beyond talking about dollar euro and dollar yen, but a lot of talk about euro versus the Swiss franc, and really looking at other countries. Also, people are going to look at Russia, for example, is going to raise its weary head again. This probably hasn't been much of a discussion yet, but I think that that's coming as well. So we're seeing all that, and part of those drivers, I know what we'll also talk about a little bit later, is that there's still this overhanging thing about, for the United States corporations, repatriation of cash, and if they have to repatriate it, then they have to pay taxes on those things, so it's almost cheaper to keep the money abroad and invest abroad. So couple the overall need to grow faster than the way that the United States right now is growing, with the fact that cash is cheaper to keep abroad, and you're going to keep really heavily investing in the emerging world.
Absolutely. As a matter of fact, last year the emerging world contributed half of world GDP. At the same time, it contributed 3/4 of global growth. Absolutely huge impact. And really what that means is that the emerging world, the world that we've called the emerging world for a very long time, has actually emerged. It is a huge component of the world economy. And we are seeing extraordinarily high growth in the emerging markets, driven essentially by 3 things. Exports to the rich world, which have grown very strongly over the last 2 decades. We're also seeing an extremely large rise in trade with other emerging markets. So you're not just seeing this from the sense that Brazil is exporting to China, but you're seeing companies from the United States that have operations in Brazil exporting to China. This is a very big game changer and greatly increases the exposures that companies have internationally. At the same time, one of the biggest influences on growth in the last couple of years since the financial crisis is the fact that a lot of cheap liquidity is coming from the rich world and being devoted to these markets. The emerging market story has been dominating the financial headlines for a very long time, and this has caused investment managers to reallocate capital to these markets. What this is essentially doing is that we're creating a bit of a dynamic where we're taking a lot of money that is what has historically been considered hot money, and we're putting it into markets that are relatively undeveloped at this stage. In other words, the financial, legal, and institutional structures are not fully well-rounded at this point in time. So what's this doing? Essentially, from a currency trader's perspective, we're looking at this and saying, okay, we might want to look the gift horse in the mouth a little bit right now. Might want to look at the fact that we're seeing rising inflation. We're seeing speculative bubbles in a lot of these currencies or in a lot of these economies. In other words, we're seeing real estate in Shanghai, for example, going up 1,800% in 2 years, which is potentially a misallocation of resources. In other words, capital that could be going into productive endeavors is actually going into real estate speculation. So what are we seeing here? Potentially a bit of a deceleration. Why? because governments are actually intervening in the markets and in their domestic economies in order to slow growth slightly and put it on a more sustainable foundation. So they're slowing capital inflows. We've seen a range of countries, everything from Brazil, Peru to Vietnam, actually imposing capital taxes against investment that's put in and then withdrawn. We're seeing lending being tightened. We're seeing interest rates being pushed up. And we're actually seeing intervention in the currency markets. In other words, Brazil, for example, actually intervening in the markets to buy U.S. dollars and sell the Brazilian real in an attempt to push the currency's value back down. Now, why is this happening? Because China is the big dominant influence on the market right now. The fixed exchange rate regime in China is forcing other countries to adjust to it. So when currencies rise to a spectacular level, driven by capital inflows, we're seeing competitiveness erode in some of these smaller countries. So we're seeing a lot of countries actually deliberately intervening to slow that growth and to put their economies on a more sustainable footing. So this is actually a very good thing in the long run. We're looking at economies that are actually more dispersed. In other words, there's growth more dispersed outside of the currently fashionable BRICS, for example. So just as Wolfgang was saying, we're seeing money going into South Africa. We're seeing growth happening in Vietnam versus just in Brazil, Russia, India, and China. And at the same time, we're also seeing a more sustainable pattern of growth. Prior times in history, the late 90s, for example, we saw a huge inflow of capital into the Asian economies, and ultimately that ended in tears. This time around, we're seeing economies being run in a much more sustained, intelligent fashion. So it's a very promising thing for the world economy. So what impact is all this having? Ultimately, currency markets are driven by the financial markets. In other words, financial flows greatly outweigh the impact that world trade has on exchange rates. Right now, we're looking at something around 1,400 trillion a year floating through the currency markets, and less than 60 trillion a year that's actually related to trade itself. So ultimately, what we need to be looking at is what stories are driving the financial markets. We're seeing improved earnings. The companies that did pull in their horns during the financial recession are actually really making good profits at this point in time and using their cash to invest in the economy. And this is improving lending conditions right down to the small business level and boosting growth overall. At the same time, we're seeing optimism rising. So this is a very, very good thing. We're seeing the fact that consumers are willing to open their pocketbooks. Retail numbers in the States over the Christmas season were very positive. And we're starting to see something that looks like a sustainable recovery. That being said, what all this means is that central banks and governments that had put a lot of effort into sustaining the markets and boosting asset prices, those governments are now having the cause to begin withdrawing some of the stimulus. So in other words, this year we're looking at governments actually halting some of their stimulus spending, not announcing new spending, and at the same time starting to withdraw some of the liquidity that was put into the financial system. Why is this occurring? Because inflation expectations are rising around the world. Everywhere from the United States to the United Kingdom to Europe, we're actually seeing interest rate expectations rising because inflation expectations are rising. The Federal Reserve, there are very few out there that do assume that we'll see another stimulus effort. In other words, another asset buying program. We do expect this to end at some point. And therefore, we're looking at a withdrawal of some of the liquidity that's been flowing through the financial system. What does all this mean? It's a very good thing. It means that financial markets are actually normalizing. We're seeing markets actually being put on a stable footing, not being driven by liquidity, but being driven by investment fundamentals. However, in this context, we have some very, very substantial risks. The first one is event risk, and maybe I'll let Wolfgang talk about that.
I mean, really what we're still seeing is, and as you, Carl, pointed out a little bit ago, yes, we have financials normalizing a little bit, but the danger here remains the politicizing of, for example, the euro, but many other countries. Look at the politics that's going on in Venezuela with some companies losing 3 to 5% of their revenues just out of Venezuela and being expropriated. But really what you're seeing here as an event risk, and this is a chart that really is could be extended around the world, but it's quite shocking that you see, for example, on this graph, Greece and Ireland lending each other money. And when you're seeing economies like that and an event happening where they're actually borrowing money where they don't even have the money to borrow it, that still keeps us on a very tight financial rope walking. And we saw what Greece, who's only 2.5% of European GDP, what it did to the global financial market. And those event risks are going to be happening more and more. It's not just happening in Europe. And the danger is, historically, these happened one after the other. But what we're seeing right now is that they could be converging, and really you could all of a sudden start having Venezuela, Russia, China, and many other countries in Europe coming all at the same time, and that is going to create significant volatility as a portfolio. So it isn't anymore, well, now the dollar-euro is unstable, but dollar-yen is pretty stable, so we're okay. These things could very well have events coming all over, and it really points to what we'll talk about a little bit later of having to understand the exposures from a portfolio point of view and not just dollar against 5 currencies. Those days are over.
Absolutely, and you know, really at the end of the day, what we're looking at here is greater interconnectedness in the financial system and in the world economy. So when we look at the unrest that's currently happening in Libya and impacting oil prices and impacting asset prices around the world, if you trace that back, a lot of that has to do with the impact of rising commodity prices. So we saw commodity prices rising over the last 2 years as a lot of new liquidity flowed into the markets, and as the emerging markets demanded more and more of the commodities themselves, we saw those prices rise. As those prices rose, you saw a much greater impact on the poor. So the poor were devoting greater and greater amounts of their income to actually feeding themselves. As this happened, this caused unrest in a number of countries, caused a lot of political instability, and ultimately it translated into some of the revolutions that have overthrown governments in Egypt and Libya so far. So you know, this interconnectedness is a huge thing to consider. Previously, at prior historical periods, we had events that would happen like this in disconnected parts of the world economy, and they would have little to no impact. Today, they have an enormous impact. What does this mean really at the end of the day? It means that you have a correlated risk. You have a risk that the economic conditions under which your company operates will be impacted at the same time that you have the risk that the currency markets will be impacted and your bottom line impacted as a result. So now, what are we looking at here as the financial markets normalize? Potentially a bit of an asset price correction in some areas of the economy where liquidity is withdrawn and therefore asset prices correct to something closer to fundamental values. And at the same time, we're looking at what we might call the new normal. Mohamed El-Erian, the co-president of PIMCO, called it the new normal after the financial crisis, saying that growth would be found in the emerging world and not in the developed world, and you know, essentially saying that companies and investors needed to be moving their assets into the emerging world. And that very much proved to be accurate. Now what we're seeing potentially is a bit of a convergence in fortune. So in other words, the developing world is growing more aggressively than it has for the last couple of years, and at the same time the emerging world is actually cooling a little bit. This has huge potential impact on the currency markets in the sense that as the economic fortunes of the two areas of the world economy converge, we're actually seeing funds flow back to the center of the financial system. You know, this potentially could have a huge impact on volatility. So what are we really saying here? Ultimately, that currency markets are terribly unpredictable. The underlying trends and dynamics that affect the currency markets themselves are very unpredictable, and then you have things like event risk that can completely throw a forecast out the window. So what we're going to be discussing here over this session and over the next 2 webinars is the fact that impact can be understood and managed. There are a lot of strategies for actually understanding what that impact is and actually managing it. I'll hand it over to you there, Wolfgang.
All right, thank you. Well, it's been an interesting impact, even for corporations. Really, what they got to look at, I need to understand it, I need to think about managing it, and I certainly need to think about monitoring it. And understanding your exposure in the new world, we've seen actually quite a few companies that historically may not have been or may not be managing, for example, their revenues and cost of goods sold from a currency impacts point of view, and still may decide not to want to manage may not want to manage that process. There's a lot of projects out there right now of people saying, look, at least I need to really understand how these currencies are all going to impact me and what are those exposures really, and they're not just going to be the 3 or 5 major currencies. It's really thinking about how it impacts your revenues, and quite frankly on the earnings calls being able to even talk intelligently about the exposures and exposures in the new world. As we're expanding into countries, what does that really mean from a risk perspective point of view? And then really understanding then, and not just after the fact, but ahead of time. So don't have Venezuela surprise you and all of a sudden saying, sorry, we have 3% of our revenues just locked up and we've been expropriated. Was that on the rise? Do you really understand your exposures? Lots of projects there, and we'll talk a little bit about the cost of goods sold, et cetera, there. And then really, what does it really mean from a risk point of view? So exposures used to all be lumped into one. Well, I've got $500 million worth of exposures, and the majority are in G, 5 and 10s, and therefore my value at risk of my general portfolio is roughly 10%. That isn't good enough anymore. It's really needing to understand, okay, where are all my exposures and what's the true risk of those exposures, and then we'll talk a little bit more and start to, and then establish that further in the other 2 sessions. Talk about how can we actually want to look at risk reward and of the portfolio of currencies impacting the companies. So one of the areas that we're looking at companies really looking to measure and understand those and then monitor them at a very minimum as well as possibly manage them is really how do they implement and adjust. And there's a couple really significant trends that we've seen happening over the last 12 to 18 months. One of them is that really most corporations are reviewing their policies with respect to currencies as well as the processes. Are they really established? And we're not just seeing that coming internally and coming from internal audit or coming from the boards, but we're actually seeing a significant increase of audit firms asking about these processes because, quite frankly, a lot of these areas are starting to be, because of the increased volatility, materially impacting financial results. One of the things that we're also seeing as part of that process change is that the looking at it once a month, kind of 10 days after the end of the period, isn't good enough anymore. You need to understand it more frequently. That doesn't mean one needs to necessarily manage it more frequently, but what's the process really to understand those risks? Another significant change that we're seeing is because of this volatility, really there's a conversion towards really looking at it from daily rates point of view. And so we're seeing a daily rates position really being adopted more. So what does all that lead to? It ends up leading to that manual processes aren't really going to be able to handle these policy changes, and you're going to look at automation, you're going to look at the analytics of that, and really the intelligence. And when you're looking at those 3 areas, especially on the analytics side and then the intelligence side, you can really categorize it into 2 main areas and then even dissect those. The obvious areas are Financial Accounting Standard 52 from the balance sheet going into the income statement, as well as Financial Accounting Standard 133. But looking at those areas, if you start from the top, what is one of the questions that a lot of CEOs, CFOs, and treasuries now are getting is, what are the real revenue impacts and what are the flows of currencies that impact our revenues, and what could that mean from a revenue point of view and then from a cost of goods sold and operating expenses point of view, and how does that net between the 2, and then look at how does the balance sheet impact that to get to a net income, because at the end of the day it's still all about earnings per shares, or in some companies EBITDA obviously above the line. But really understanding, we're seeing a lot of projects really focused on understanding the exposures and how they impact those certain areas. So, you know, to take that for the next standard for really what does it mean as a process is once you understand your exposures and really have dug into them and categorize them and being able to create trends from the past, et cetera, you really need to understand what is the resulting risk of that. So saying that I've got $1 billion worth of exposures could be somewhat meaningless if you're doing that against the Hong Kong dollar versus doing that against Brazilian real or Russian ruble. So what is the actual risk? The exposure numbers are always very large, but they're really not that well understood. So really defining risk as your exposure times the volatility. And what we're seeing there is really from a corporate point of view, looking at volatility through a VAR of a 99th percentile confidence level, looking over the last 3-year data. But one has to be very careful, as Carl mentioned earlier, is historical volatilities are not necessarily the future volatilities, especially if you're looking 3 years back versus the last 12 months. So one has to be careful of really understanding and updating that risk. And once one understands that risk and is able to communicate that properly, then really look at do you accept that risk, or do we want to actually do something about it and reduce the exposures? What are the strategies, and then how do we execute it, and what are the results? There are definite processes that have been in place by many, many corporations that are tried and true to manage this to plus minus zero around zero. So as I know we're going to dig into that in part 2 or part 3, let me just start by talking about that there is a increased view of currencies impacting and looking at it and really communicating the risk-reward benefit of managing and mitigating that risk. So if we take, for example, this core analysis here that's become pretty widely known, is there's a couple factors that people look at. The first dot on this would be, what is the true value at risk, talking about that 99th% confidence level, and then, as you see on the x-axis, what is the interest rate differential to manage or hedge that risk? That's a basic risk-reward. My risk here is my value at risk. My cost to manage that could actually be positive or negative. I could have interest rate differential as an income. So as we're looking at a portfolio, as this next line coming in, there. So really this line is now the hedging impacts of reducing risk and what income or cost it is. Currency, quite frankly, not even identifiable here. Obviously the underlying data is, but really very crisp and clear, letting people understand what's the risk and what's the cost benefit of that. In this company, it had a $22 million risk, and they could manage that down to zero with an income of $120,000. Now, really, internally, companies have the ability to go and ask senior management all the way up to the board is, where do you want us to be? Do you want us to take $22 million risk? Do you want us to reduce it down to $4 million and at a $200,000 quarterly income, or do you want us to get it down to zero? And I'm sure we'll touch more on that in the next part, so let me kind of move on these things. So a few takeaways here that I really encourage everybody to take a look at. The first one is, look at your worst, not just losses, but also possible gains. What is the largest quarterly foreign exchange impact one has had over the last 2 years? And if you double that, that's probably a pretty good indication of what your true risk is today. And then ask yourself the question, is that an acceptable risk? And then if it is acceptable, then that's probably nothing to worry about for today. And then just keep an eye on where are we growing, what areas, and what risks are we taking. And if it is too big of a risk, then really digging into understanding it and getting constituents that may not be perfectly familiar on currencies, which obviously is a complicated area, comfortable with a risk-reward analysis, for example, like that core analysis. Dig to understand what is it above the line from a revenue and cost point of view and communicate that properly, and what is it from the balance sheet coming into the income statement below the line. So taking definitive actions and really also easing the mind of lots of constituents by not saying, look, the minute I understand my exposures, first thing I'm going to do is just hedge everything, but really what can one do internally from a structural point of view and an operational point of view, and then lend comfort to the fact, look, we've done everything internally we possibly can. Now the only thing left is to hedge, and here's what the risk-reward of that is. And if you go through that process continuously, you'll get a lot of constituents saying really understanding it and buying into the process and increasingly focus on how to protect one's company. I know we're running a little bit tight on time, so yes, Carl?
Yeah, I was just going to say, I don't know if you're seeing the same thing, but we're definitely seeing an upsurge in people really formalizing this whole process, essentially involving everyone down to the buyer who's in India, who potentially could put an exposure on the books, right up to the board level.
Yeah, we're hearing that, and we're also hearing an increased amount of unexpected surprises, or I guess surprises are always unexpected, but really looking at, well, we've been focusing on dollar, euro, and dollar yen, but we actually just got significantly hurt by euro Swiss franc. Or, we really were surprised, obviously by Egypt and what that did, in the pharmaceuticals and the automotive industries and food and beverage area. So you're seeing more and more of these things coming from all over the place at companies. So we're seeing the same thing. And then how do I actually go and improve that process? And we're seeing that they really need to take a step at understanding it. So with that, I think we're ready to go to some Q&A, and I'll let you lead that, Ernie.
Okay, great.
Okay,
thanks, thanks, Wolfgang. Again, if you have any questions, please go to your call box and ask us a question. I think take the first question might be for Wolfgang. So what do you expect to see in the FX markets given the recent explosion in geopolitical risk in the Middle East, especially do you expect to see some movement in the euro?
I actually expect an uptick in volatility in the euro, and I really would be very cautious of hoping that the dollar is not going to strengthen against the euro and therefore will be okay in Europe. I would caution against that. I think that you've got Greece coming back up. You've got Ireland coming back. You've got Spain refinancing. I'd be really careful in that. You're going to get a lot of political rhetoric out of Merkel, as Carl was talking about earlier, but as well as out of the European Central Bank. Still remind oneself, even with dollar-euro, remind oneself that the volatility is going to come back up. It's been historically, or certainly over the last 12 to 18 months, higher, and I expect that to really flare up again, given all the refinancings of the debt as well as the political rhetoric.
Yeah, and Wolfgang, I don't know if you'd. Oh, sorry. I don't know if you'd agree, Wolfgang, but I'd say that we're looking at potentially two stages in volatility related to the Libyan crisis right now. The first is the impact of rising crude prices and what that does to movement in the financial markets today. But then the second stage would be the impact that it actually has on economies around the world, on growth expectations, and particularly, as Wolfgang was mentioning, on the European Union, which actually imports the bulk of Libyan production. So the markets could really see two stages here, a break between the two as the situation evolves.
Yeah, I completely agree, and I think that one of the things that people really haven't focused much on, it isn't just about the crude oil commodity, it's really about, there's been a lot of food and subsidy exports out of that area into Europe, acquired by Italy and other countries that really people aren't even talking about. So you're going to actually see an significant increase of those costs to Europe coming as a second wave of surprises as well.
Okay, that's great. Wolfgang, I think I've got another question for you, which is kind of a follow-up on some of your comments. So you had mentioned, that there's probably a lot more focus on FX currency management in the audit process. I know you consult with a lot of large corporations. Have you been seeing more inquiries from CFOs as they're getting these types of questions on earnings calls over the past 6 months or so?
Yeah, that almost sounds like a leading question. It's a really true question. As we referred to earlier, we really watch earnings calls very closely. We actually have an automated process to watch that as well, and really analysts are focusing on understanding how these currencies, because they are so material, could impact the company, and therefore asking CFOs to respond to that. And we actually, from our clients now, receive a the request to kind of have a one-page cheat sheet of exposures and what did they mean. What are the largest exposures? What are the largest risks? How do they impact the income statement above the line and below the line? And the CFOs and CEOs who succinctly respond to that are having a much better ride than the CFOs who are saying, well, you tell me where the euro is going, which, believe it or not, I've seen as well in comments, and you can well imagine that that latter comment is not too welcome by analysts.
Okay, great. And this can be for, maybe we can start, and Carl, you can come in on this, and this may be more of a focus of our later seminars. But, for a company, who is just going into different markets and probably maybe exposing themselves to the new currency, how does someone go about, even setting up a process to monitor and measure and monitor the things that are most important to them, and even to measure and monitor FX market volatility in general?
Yeah, I mean, I really encourage the person who asked that question to focus on that April 12th part where we're really talking about establishing that framework for success. And that's a big question. Really, two areas to focus on. One, I'm a big proponent of starting with really understanding your balance sheet, because when you really understand the balance sheet and the exposures in the balance sheet, then you can start asking the smarter questions into the forecasts and to the cash flow and into revenues and into the costs. So really, first step is really understanding the balance sheet, how currencies are flowing into the balance sheet, and then backing into it. I think a big mistake that a lot of companies historically have made is they focused immediately on cash flow, because as I'm looking 12 months out, isn't that going to have a larger impact? And quite frankly, the answer, if you ever want to solve the answer to the cash flow and the income statement, you got to really start with really understanding the balance sheet first. But I think that's part of the April 12th thing that really goes into that framework.
Yeah, the other thing I'd add to that at the same time is that a lot of this is also the internal risk tolerances and the objectives that the organization has. You want to understand what those exposures are. You also want to understand what you actually want to do about them. Understanding the risk tolerances of all the stakeholders involved, everyone from the board to the executive team to the lenders to the auditors, and adding that input into the process is the key to a good risk management program.
Okay, just a question kind of along those same lines. So, this is kind of a follow-up question. Maybe we'll get into this in later events. There was a slide up that said, accounting versus economic exposure. So how would you put that, in practical advice in identifying an economic versus an accounting exposure, and what should the priority be between those two?
That's a really good question. Accounting is obviously how people report it, but long-term one should look at economics. But really, to ground yourself, you should start really focusing on what is important for you and for your constituents and shareholders, and companies are just different in that. So there really isn't one answer that fits all. I do think that one should be very careful of thinking of accounting exposures of just being that accounting and nothing else. That is a very dangerous trap that a lot of people historically have gone into. Well, I've got an accounts receivable that's being revalued and goes below the line, therefore it's only accounting. That's wrong. At the end of the day, that exposure will one day turn into cash, and that's either money one has or doesn't have. And that is a significant disconnect that is going to readjust. You have to think about those not in pure separate buckets, but you have to think about, okay, if it's an accounting point of view, it could well become economic. So if I have sold a pair of jeans at 100 euros and I have an accounts receivable for 100 that's valued at $140, and by the time that cash converts, on the balance sheet shows at $130, I lost $10. One day when that converts at 130 to $130, you lost $10. That is $10 you don't have in the bank. So it is accounting going to economics. Those are not completely separable.
Yeah, and it's the pattern of those over time that adds up.
Oh, yeah. And then Murphy's Law adds to that, right?
Yeah, I think we have I know this will probably yet to be played out, but we have a question, as far as the financial regulations and the potential impacts that they might have on the swaps and derivatives. I know there was some initial concern that there would be some restrictions in regards to swaps and derivatives only going to exchange-traded vehicles declared. Do you guys have any sense of what that impact might be for financial regulation, or anything people should watch for as this unfolds?
Carl, I'll let you take that one first.
Sure. I think that in general it shouldn't have a huge impact. If you look at the latest Bank of International Settlements survey, they talk extensively about the fact that the OTC market is growing, or sorry, the over-the-counter market is growing very rapidly. And it's really based on the growth of outright forwards versus the swaps. We're seeing a lot of growth, especially outside of the U.S. dollar pairs, into the currencies such as South African rand. And I think that for a very long time, that's going to remain a very customized market. It's very difficult to determine exactly how the regulatory process will work out, but I don't think that it will have a material negative effect on corporations that are looking to hedge. What do you think?
Carl, I completely concur with that. I don't see that this has a significant impact. If there are corporations who are not doing, the kind of basic forward structures, et cetera, and getting very fancy, then that may impact them. But overall, I don't see this being a large impact at all. This is a discussion that we've seen for the last 25 years continue to flare up. How do we regulate the currency markets? And quite frankly, pretty difficult when you can be visiting a country and going into any bank and converting that cash. How are you ever going to regulate a tourist doing that? So why would you regulate a corporation of doing that? That's one. But you're seeing a lot of these in these sort of economic volatile times. You see a lot of these debates coming back up. What can we do and how do we regulate it? You saw not too long ago back the discussion coming back up about special drawing rights. Okay, well, we can do something with special drawing rights again. Well, we've heard that discussion for 20 years too, and that's just not a feasible alternative. But it's a discussion point, should be revisited, but I don't see the regulatory impact impacting negatively corporations at all. I concur with Carl on that.
Okay, I know this probably may not be 100% your bailiwick, but are there any accounting pronouncements or things that you might see on the horizon that might impact someone's decision on whether or not to engage in these derivatives? And we all know that accounting is really complicated on that front.
Carl, you want to take this first, or you want me to?
I'll defer to you on that. Although I think that the formalization of accounting procedures is actually making hedging easier and more effective. Put it that way. The impact is more easily understood given the evolution that's occurring. So longer term, I think the accounting complexity is likely to actually go down. I don't know if that's what you would think, though, there, Wolfgang.
Yeah, I think in general that's correct. I mean, I think during the Sarbanes-Oxley days, we have certainly seen the pendulum swinging very far into one direction of regulations and looking at other financial procurements, et cetera. I think from the derivative, there's two areas. One is when you're looking at derivatives products, I think staying plain vanilla and sticking to the basics. I don't foresee any pronouncements there. One pronouncement I do see that's coming out, and that really was also why Financial Accounting Standard 52 came out, is really the major disclosures of those. Today, the disclosure requirements of what corporations are doing can be very loose. So you can say, look, I've got on the last day of the quarter, I had $100 million worth of forward contracts. Really, that alone doesn't tell the investor very much, because did they have $100 million worth of exposures? Did they have no exposures? Did they have $500 million exposure? What does that mean? I think you will see some disclosure requirements tightening up, but it's not going to impact otherwise how companies are doing their business. So that's the only trend I'm seeing.
Okay. Sure. So for those that might be a little bit, newer to getting involved in the derivatives and swap markets. I know this is down the road, but can you please comment in general as far as the transition to IFRS, whether or not the accounting pronouncements seem to be more or less complicated in regards to derivatives?
I'd certainly say less complicated in the long run, once they're easily understood. The cash flow impact is nullified given the new regulations, so that should make it a little bit more stable. And as Wolfgang was saying there, it provides enough information to eliminate some of the subjectivity that was occurring prior to now. So I think it's a favorable development.
Yeah, I agree. I think that overall, change always creates some uncertainty. So at the beginning, it's going to be a lot of focus and, oops, I got to change processes. But I think it all points back down to the fact that, the past of looking at 5 currencies and having a manual process to understand it, manage it, and monitor it is just that. It's the past. There's going to be more requirements of just really understanding it and more from a portfolio point of view, not just dollar against 5 currencies, and then reporting it as such. Just that this is what it is, and getting back down to the basics, and then they're going to tighten up what those basic requirements are.
And really, at the end of the day, all of these accounting regulations serve to put more focus on the risk management process itself. When we're looking at hedging or risk management as a means for smoothing out cash volatility, I think that the accounting regulations are actually going to serve to allow investors to pull some of this out of the statements and actually see where risk is being mishandled or being handled well in contrast.
Yeah, I think that, and that's really a good thing. I mean, everybody sees, well, there's a change in these accounting things, and that's a bad thing. For corporations, it can be a very good thing. Let me go back to that example of that $100 million exposure. If somebody sees that $100 million of derivatives on the books in item 7A of the 10Qs and 10Ks, for example, and says, wow, they got $100 million worth of derivatives, the VAR of that is $10 million, so that's $10 million worth of risk that the company is taking. Was that really true? Probably not. Probably what they're trying to do is reduce their risk. So if the investor would know, look, we have $150 million worth of exposures, and I've got $100 million of derivative products that hedge away whatever that is, 65, 66% of that exposure, I'm really left with only $5 million worth of risk. That's better for the corporation because it takes uncertainty out of the investment. Therefore, as you have higher predictability, you're going to have a higher valuation, and it gives more certainty to the equity markets and to the holders. Overall, that is actually a good thing.
Okay, great. As we start to wrap up the Q&A session here, I'd like to, take this back to, I think, what is at the core in this first series. I've got a question, from an individual, who says, I understand that I have exposure to the euro, so can you give me, some sources, for how do I assess, the volatility of the euro? How do I keep track of that? And then is there any advice for me to get out in front of a potential source of volatility that may have a significant impact on my company?
Okay, so that question might be something that we could follow up via email perhaps later, just so that we can provide a more comprehensive data set. However, as Wolfgang was mentioning there, what most companies want to do is something along the lines of a value at risk analysis or a sensitivity analysis, and you generally want to use what they call an average true range for that currency pair over that period of time. So if you're looking at a 3-year time period, you want to look at what the average true range was over that period of time. Same thing for over the last 15 days, for example. That'll give you an idea as to what sort of extreme moves we've seen in the past. That being said, though, historical volatility is a poor predictor of what will happen in the future. The mathematicians call it a jump diffusion model. In other words, currencies tend to follow a long-term diffuse pattern before we see extreme jumps in one direction or another. And really, analyzing prior volatility is a poor indicator of what might happen there. In order to understand what might happen there, I would say that the only reliable indicator is to look at history to understand that we've seen extreme moves happen throughout financial and economic history, and some of those have proven to be extremely large and long-lasting. So it's important to remember that those are out there, they will happen, and that they're going to impact you.
Sure. Thank you very much.
I would just
close. Go ahead, okay.
I'd just like to add the thought to that really when you're looking at currencies impacting your corporation, put your investment book away. I mean, really, this is about risk management of impacting a corporation's balance sheet and income statement. This isn't about asset management. And I've seen a lot of times when people start in this area, they start thinking about it from an investment point of view. And the difference there is that from an investment point of view, a 1 or 2 standard deviation, 95% whatever confidence level is okay, and looking at over a long period of time is okay as well. But what that really means from an impact point of view, just to separate the two, is if you're looking at a 95% confidence, that means there's a 5% likelihood that you're going to exceed the defined risk. That's very dangerous to one's job to relate to upper management. So highly encourage people, and we've seen this, people always get into this discussion first, well, should we define it as a 95%? And there's definitely the vast majority of companies, when they really think about go to 99% risk, to really define that risk in a conservative and communicate it in a conservative fashion.
Okay, great. Thank you very much. With that, I'd like to close the Q&A session of our webinar this morning. Once again, I'd like to thank Wolfgang Kolster and Carl Shimada for their valuable time and insights, and also our sponsors, Western Union Business Solution and Fire Apps. And I'd also like to thank the audience for your valuable time. So with that, I would like to end the webinar this morning. And thank you very much, everyone, again, for your time. And everybody, have a great day. Thank you.
Thank you.
Thank you.